Okay, so welcome to my brief introductory video about the effect of information technology on the auditing process. As you can see from this introductory cartoon, information technology systems can have a big impact on the segregation of duties and therefore on the risk associated with internal controls. So here, the gentleman saying our budget won't allow us to buy a segregation of duties software package, so the auditor said we'll all have to press the enter key together. So this is obviously a joke, but it actually illustrates an important point, which is that when you have an IT system, you will have centralized entry of data. So what that means is that if the person operating the computer makes a mistake in entering the data, that mistake will show up throughout the company's accounting records. So for example, if a credit sale is entered incorrectly as $1,000 when it should be $100, then the sales will be overstated, but also accounts receivables will be overstated. Now, in the olden days when accounting used to be done on a manual basis and they didn't have computers, the double entry bookkeeping system would help to identify recording errors, so that if, for example, the credit entry for the sale was recorded as $1,000 instead of $100, but the credit sale was recorded correctly as a debit in account receivable as $100, then that would show up as an inconsistency between the debits and credits. In other words, the accounts wouldn't balance. And that's why double entry bookkeeping was invented in the first place. It was to help organizations to identify recording errors. But in a computerized system, you don't have that control procedure because the data is entered once onto the computer, and then the computer posts both the debit and the credit entries. So automatically the accounts will balance even if there has been a recording error. So anyway, that's one of the issues that arises with using information technology. Now, the outline for today's seminar will go through the following objectives. First of all, I'll explain how information technology affects risk. I will cover that in this introductory video. And then in the class, I will talk about the difference between general controls and application controls, and I'll describe how those controls should work. The third objective is for you to understand what's the difference between auditing around the computer versus auditing through the computer. So I'll explain the circumstances in which an auditor audits around the computer versus auditing through the computer, and then I'll talk about the different ways in which you audit through the computer. Auditing around the computer is essentially a traditional audit where you can ignore the client's computer operations. Effectively, you're circumventing the fact that the client has a computer system, but when you're auditing through the computer, you need to consider additional methods. Okay, so those are the 4 learning objectives for today. In terms of the class reading, you need to read this seminar outline, including the class questions and the student presentation. I'm currently giving the video that you're now watching. I've recommended some reading from chapter 11 and 12 from the Ahrens, Elder, Beasley, and Hogan textbook. So you can read that if you wish. And then there's some additional reading for the students who are giving the presentation. This is an article titled Business Continuity Management. So in terms of the questions, I have a question here about systems development at a company. And questions are, what are the strengths of the current systems development and program change processes of the company, and what are the weaknesses? Okay, so A is strengths, B is the weaknesses. So you read through this case and identify what you think the strengths and weaknesses are. Then we have some multiple choice questions, quite a few of those. And then we have the student presentation, which is about the risks associated with information technology, and also the things that audit committees should consider with respect to information technology. So those articles are going to be quite helpful for answering the questions at the bottom. The questions are, what are the major risk factors associated with using a computerized accounting system? What 10 questions should audit committees ask about their company's IT systems? And then how can internal auditors help when there is a major disaster with an IT system? Okay, so that's for the student presentation. All right, so those are the learning objectives that I've just talked through. What I'm going to do now is talk about the pros and cons of having an IT system. So of course, nowadays, almost every company, even small companies, will have information technology systems to record and process business transactions. So what are the advantages of using an IT system rather than the kind of manual accounting system we used to have in the olden days? Well, the first one, of course, is that IT systems are more efficient. The firm can employ fewer people. So that's a good thing. That helps to reduce the company's labor costs. There's less risk of human error. Right? If you've got a manual accounting system, for example, a human might add up a column of numbers incorrectly, right, if they're using a handheld calculator to do that. But if you're using a computer to add up a column of numbers, then it will always give the correct answer. And then thirdly, there's more scope for data analytics, right? So for example, the company and the auditor can perform an aging analysis of accounts receivable. They can also identify the time and the identity of the person who records the transaction. So that can be useful for identifying unusual transactions. So for example, if a sales transaction is recorded at 11 p.m. on a Sunday evening, that would be unusual because generally speaking, employees are working from Monday to Friday, 9 a.m. to 5 p.m. Okay, so you can look at the timing of when the data is entered into the system to identify unusual transactions that require further investigation. And you can also identify the person who records a transaction because the person is operating the computer system using a username and a password, then the computer can automatically record who that person is. So for example, if you suspect that certain sales have been overstated, then you can identify the person who is associated with that over recording of sales. So these are some of the advantages of using a computerized system. What are the main disadvantages relative to a manual accounting system? Well, firstly, there's a loss of audit trail. The whole point about having a computerized system is that all of the data is held electronically inside the computer, right? So whereas in the olden days, you used to have a lot of paper, a lot of printout, you don't really have that any longer. So that loss of trail of documentation makes it harder to audit. For example, when you're doing a transaction walkthrough. So that's one of the difficulties that auditors face. Another difficulty is that there's a higher likelihood of systematic errors. So if there is an error in the client's software programming, then that error will show up in all of the output because the computer system will treat every transaction in the same way. So if there's an error that is built into the software, right, if the software has some bug, then that's going to automatically show up in the computerized output. Thirdly, there's a potential for unauthorized manipulation of data. So when you have all of the company's data on the computer system, there's always a potential for somebody to enter into that system, perhaps through hacking the system, or if there isn't proper control over passwords, it's possible that an unauthorized employee may make changes to the data. Fourthly, a lack of traditional segregation of duties. Right? So for example, think about the separation of duties that's required between operations and accounting. We require sales operations to be separated from the recording of sales transactions. Right? That's for good internal control, because the people who have responsibility for making sales, that's those people who have the sales operations responsibility, they might try to overstate their sales in order to increase their compensation or to get promotion, to make their performance look better. So we would generally prefer to have separation of those people who are responsible for selling the company's products and services versus the accountant who is responsible for recording the sales that have taken place. But in a computerized system, that may not happen, right? It might be that the salesperson, after he's out there and he's agreed an order from a customer, he enters the customer's order directly onto the computer system. Okay, so that means there's a loss of the segregation of duties. And then fifthly, there's a lack of traditional human authorizations, right? So sometimes the authorization process can be built into the software, okay? And that's okay as long as the software is working correctly. So for example, there may be a reordering requirement built into the software such that when inventory falls below a certain level, then more inventory is ordered automatically. So in that situation, it's the IT system that is actually implementing the authorization of the inventory purchase order. Okay, so as I say, that's fine as long as the order of inventory is actually necessary for the company. But it could be, for example, that the IT system just continues to order new inventory even if that inventory is not required. For example, if the company switches from manufacturing one kind of product to manufacturing a different kind of product, and the new product doesn't require some raw material that was required for the old product, then the company, because it's had this ordering system built into its software, it may find that it automatically places an order for replacement inventory, even though that's not necessary. Okay, so sometimes computers are not as smart as humans. Essentially, that's the bottom line here, right? A human may be able to spot that the company shouldn't be placing an order, whereas a computer will just place an order because it's been programmed in the software to make that order as soon as the inventory falls below a certain threshold. So those are the kinds of risks that companies face when they use IT systems. Okay, so we'll start off the class by going through the student presentation. The 3 questions we're going to cover in the presentation. Firstly, what are the major risk factors associated with using an IT system? What are the 10 key questions that audit committees should ask about their company's IT system? And then finally, how can internal auditors help when there's a major disaster with the IT system? Thank you for watching.